Welcome to the Upside Journal podcast. In 2026, domestic venture capital is struggling with extended exit timelines and dry powder gridlock. Yet a sophisticated layer of cross-border diaspora business networks is quietly unlocking predictable, counter-cyclical returns in AI and climate tech. Today, we're breaking down the hidden alpha traditional funds are missing.
Here is the executive briefing docket for today's teardown. We are going to systematically unpack 4 areas. First, the 2026 VC paradox. Second, how M&A is functioning as regulatory arbitrage. Third, we'll dive into supply chain edge and infrastructure. And finally, we will map out the contrarian diaspora playbook.
All right, let's jump right into part 1, the 2026 VC paradox.
So, we are starting with a massive, glaring macroeconomic paradox. If you're looking at early-stage funding right now, it is incredibly scarce. We are seeing a complete tightening of capital markets. Yet, simultaneously, we are seeing this historic, unprecedented wave of massive corporate buyouts. The headline number that mainstream analysts just keep celebrating on an endless loop is a 72% surge in African tech M&A over a trailing 12-month window. And the prevailing narrative frames this surge as the ultimate proof of ecosystem maturity.
But frankly, that consensus narrative is a complete illusion. When you actually peek under the hood of these megadeals, you realize this rapid consolidation is not about operational efficiency at all. It's purely defensive. These massive tech primes are using acquisitions to basically hide their own stagnant internal growth. They're constructing these massive, anti-competitive corporate moats, effectively turning the digital economy into an oligopoly that actively suppresses early-stage innovation.
Exactly. Just look at the specific transactions driving this volume. Beltone Holding executed an incredible $19.7 million buyout of Baobab Group, essentially to instantly capture 7 African markets in one move. Then you've got Moneypoint integrating Sumac Microfinance Bank, and Flutterwave swallowing up the open banking pioneer Mono. Now, publicly, these deals are framed as synergistic product expansions, but let's be real here. In structural reality, these are highly calculated corporate roll-ups. They're designed to mask that internal growth stagnation right behind the formation of these giant Pan-African super-conglomerates.
Okay, pivoting to Section 2, M&A as regulatory arbitrage. To really understand the systemic risk here, we have to look at the underlying business mechanics driving these Tier 1 prime deals. This isn't your standard market expansion. It's a textbook execution of regulatory arbitrage. Because, as we all know, securing operating licenses across central banks is brutally slow and wildly expensive. So, legacy giants are executing this clinical 3-step playbook. Step 1, target a smaller, localized entity. Step 2, capture their regulatory license so you can instantly bypass that regional friction. And Step 3, which is frankly the most damaging, you abandon the target's original independent product roadmap. The industry literally loses an independent builder, and they're replaced by a mere compliance layer for a dominant conglomerate.
And this dynamic creates what economists call an oligopoly. It's a market condition with very few buyers. Because there are now really only a handful of regional tech conglomerates controlling the ecosystem, they basically become the only viable buyers in town. And this immense market power gives them the ability to artificially depress or even inflate early-stage software valuations. It creates a complete valuation trap, entirely eliminating the prospect of competitive, multi-bid corporate acquisitions for seed-stage startups.
Right, and that valuation trap leads to a really devastating secondary effect, the systemic lockout of agile, high-conviction diaspora angel capital. Historically, the African diaspora deploys capital to back high-risk founders long before institutional VCs will even take a meeting. But those syndicates require transparent, competitive market dynamics to actually scale and achieve local innovation. So these artificial valuation landscapes engineered by the tech primes, they are actively choking out those crucial open market channels.
Which brings us to Section 3, supply chain edge and infrastructure.
So, beyond just choking out early capital, this hyper-consolidation poses a massive structural threat to the broader cross-border digital economy. The financial technology vertical in Africa is an estimated $230 billion market. That's a staggering amount of capital, but look at where the foundational plumbing actually sits. The core infrastructure is now perilously hyper-concentrated. Roughly 85% of it is controlled by a few Tier 1 corporate primes, who have essentially swallowed up the core infrastructure into these massive centralized entities, leaving only a 15% slice for independent builders.
By centralizing these critical layers, we're talking API infrastructure networks,
card processing corridors, open banking integrations, right down to identity verification and underwriting, we are engineering massive single points of ecosystem failure. Think about it. If just one of these super-conglomerates experiences a sudden liquidity crunch, a severe regulatory sanction, or, even just a technical glitch, the fallout would be immediate. We're talking hundreds of independent third-party apps and cross-border merchant corridors going dark simultaneously.
And this is the harsh structural reality that the mainstream consensus just completely refuses to acknowledge. By encouraging the creation of these massive corporate structures, the ecosystem is trading its long-term, systemic operational resilience strictly to preserve short-term corporate stability for a select few primes. It is a dangerous, systemic ecosystem risk.
Let's pivot to the synthetic alpha in Section 4, the contrarian diaspora playbook.
So the real question is, how do independent builders and investors actually outmaneuver this? Well, the foundation of this new strategy lies in one massive, undeniable number, $62 billion. That is the record projected volume of 2025 sub-Saharan remittances. But here is the critical shift. It is no longer just passive family support. That capital is actively being converted into institutionalized, multi-yielding, sophisticated venture capital.
And this capital is funding what we call the contrarian Diaspora playbook. You see, founders can no longer just rely on the traditional exit playbook. You can't just build a niche software feature and pray for a quick corporate acquisition. That is a dead end in this oligopoly, and it just yields terribly low returns. Instead, the contrarian goal is to build sovereign protocols. By anchoring platforms to open frameworks like the AFCFTA digital trade protocols and utilizing decentralized financial networks, builders are creating their own sovereign distribution moats. They're completely bypassing the Tier 1 tech primes and building high-resilience systems.
In this highly sophisticated layer of cross-border diaspora capital provides the exact structural advantage needed to survive early volatility and execute this exact playbook. First off, earlier entry. They are way more comfortable with pre-institutional risk than traditional funds. Second, local intelligence. They have a massive edge in navigating asymmetric information and complex regulatory nuances. And crucially, third, longer commitment horizons. They are focused on long-term national alignment over short-cycle fund optimization.
Ultimately, this intelligence briefing boils down to an urgent imperative for structural diversity across the African digital economy. As the report so clearly states, true alpha is not built by constructing massive anti-competitive moats, it is unlocked by empowering independent, cross-border innovation. We absolutely have to move past the illusion of the oligopoly.
So for the institutional allocators and strategic founders listening, the landscape of 2026 demands a hard decision. As you deploy capital in this coming cycle, ask yourself, will you surrender to the oligopoly illusion, or will you build sovereign distribution moats?
Capital has become highly commoditized, but the infrastructure to execute high-trust, cross-border deal flow is rare. To get ahead of these macro signals and access our premium investor network, subscribe to the Upside Journal and join our membership communities. See you in the next Daily Drop.